This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals. Hey, welcome back, everyone, to another episode of Eat, Sleep, and Invest. I'm your host, Brian Driscoll, and I'm here with John Casmon. What's going on, John?
Hey, Brian, I'm doing great. How are you doing today?
Hey, doing well, thanks. Thanks for coming on.
Yes, sir. Excited to be here today, man.
Good stuff. Hey, so give a little background for everybody, because I know you deal with a lot with the multis, things like that. Give everyone a little bit of background on what all you're into.
Yeah, so I'm a multifamily investor primarily, but I also work with other investors. So basically, I do apartment syndications where we partner with other investors, busy professionals. They work with us. We go out, find properties, put the deals together, oversee them. They get all the benefits of investing in real estate without the headaches of actually being a landlord. So we've helped over, a lot of investors at this point. We've invested over $100 million worth of apartments, and we focus primarily on the Midwest and Southeast region. But I didn't always do this. So before I got focused on real estate, I was in marketing and advertising, and I did that for 15 years. I worked on large brands and worked for General Motors, worked for an advertising agency that worked on campaigns for Nike, Coors Light, Mountain Dew, and a lot of other big nationally recognized brands. And the thing that really happened for me is that job security wasn't that secure. So when I was at GM, I was there from 2007 through 2011, and that was the same time frame where we went through bankruptcy. So that anxiety and job loss was something I lived through almost on a daily basis. And I watched a lot of my peers kind of go through that. And even on the agency side, anytime an account was lost, sometimes you'd have to right size and some people would get let go. And even that business, we went into bankruptcy at one point. And fortunately for me, I didn't lose my job. I never missed a paycheck. But, just having that happen real time twice, it just showed me that the job wasn't that secure. And in fact, real estate was a more secure and better option for me.
Yeah, and you know what? That's a good point, too. We have a lot to talk about, too, because you do the marketing and the real estate. So, nothing is stable. Like, real estate's not going anywhere. If you buy it properly and take care of the property and get good people in there, it's very secure. Versus you're right. If you have a job, you're relying on other people in the market. Like, back in 2008, places are going bankrupt. That's, really nobody's control. Just, hey, you know what? You're out of a job.
Yeah, and there's a lot of components to it, right? I mean, let's say you're amazing, right? And I was pretty good, but the reality is, and I like to be very practical with the situation. I was a junior person when we started that process, so I was cheap, right? And when they're looking at a guy who's making maybe twice what I was making and looking at me, and they saw what I could do, it made it easy for them to say, keep John, let the other person go, right? But at some point, I'm the other person. And now they're going to look at it and say, okay, John's good. He's great at his job. We like him a lot. But when you start looking at the numbers, that's a big salary on the payroll. Conversely, politics come into play. Maybe you're good at your job, but someone just doesn't like you. Maybe you're in their way. Maybe you got a promotion that they thought they should get or whatever it is. And all of that starts coming into play, right? On the flip side of that, what if you have a job where you need your mind or you need your hands or you need to do something and you lose that functionality? What if you're a surgeon or, you have some other illness or disease, and you certainly don't wish this on anybody. But if you have a specific way of making your money and something happens, well, now what? And real estate is that equalizer where you don't have to have any of those things. If you, lose the function of a body part, if your memory starts to go, if you have, brain issues, there are a lot of different ways you can still make money in real estate and bring on other people to run it, as opposed to only relying on that W-2 job. So I do think it's more secure from that standpoint, especially if you buy it right in the first place.
Yeah, 100%. And I think a lot of people have the misconception too. It's like, I got to get into real estate and do that as my full thing. Real estate's a good hedge too. Like when you're working, even if you have a W-2 job, you don't even have to go out and quit. Go buy properties on the side so you have that income coming. Because if you lose your job, you have that as a buffer,
And that's exactly what we did, right? I mean, we started in 2012 with a 2-unit, lived in one unit, rented out the other, called it a house hack. And that's what kind of started the ball rolling. From there, we bought a 3-unit, then we ultimately bought an 8-unit, did some flip projects. And then we decided to scale and really commit to investing in real estate and building a business out of it. But the goal starting out was simply, hey, if I lost my job, I want to at least be able to cover my bills. I want to give me some leeway here to figure out what's next. And that really came from watching my peers who didn't have a plan B. And they lost their job, they got their severance, but they had no idea where that next check was going to come from. And having a real estate portfolio, at least you know you got this coming in, and maybe you got to supplement that with the job or other income, but at least you have something there that you can start planning around.
Right. Nah, I like that. So you're primarily dealing with multis now, right?
Yeah, we are, because the scale is important for us, and scale is I look at it a couple different ways. One is scale for the units themselves, how many units do you have, and all of that. But really, the scale is important for a management standpoint. When I had the 3-unit, the 8-unit, those properties, well, even when I hired a property manager, I still had to be very heavily involved. The folks you're going to get to manage an 8-unit building, they're not 100% committed to it, right? They've got other properties they're managing. So they're not thinking about your property every single day. When they're showing it, it's a job to them. They got to show yours, but they got to show 3 other properties. So they're going to quickly do whatever they need to do and move on. So you're going to be heavily involved and still overseeing your property. But as you scale up and you get to 100 units, 150, 200 units, well, now you have professional property management companies, but you also have on-site personnel. So there's someone whose only job, they get a salary, and their job is to be at that property and manage it. So all the time, they're talking to every resident. They're looking at the property. They're walking it every single day. They know that property in and out. They know what the property needs. They know the feedback they get from residents, and they're going to be solely dedicated to that. That's going to make it easier to manage and easier to grow. And then the other thing with commercial real estate is the way it's valued. I'm not worried about what the neighbor down the street gets for his house. We're focused on creating a business where we know the things that we're going to do, the renovations we make, the business plan we have, it's going to drive value because of the way the properties are valued. So that's the thing that makes it really unique for us. But we can also raise money and we can work with other investors. And that's what's great for other people is if you're looking at, going in and maybe flipping a house yourself or buying a rental property, maybe fixing up a little bit, but you're going to manage it or you're going to hire a manager, you can do that way. But another alternative is you can invest with a group like ours where we go out, do all those things, but the property is big enough, the operations are big enough where you can actually make a profit investing passively. And it's just much harder to do that on a small deal.
Right. And yeah, even like investing, like you're talking about too, investing with you guys like in a syndication, you get the tax benefits as well. So you get,
that's right.
It's pretty much turnkey. You have professionals dealing with it to deal with doing that all the time. Plus you get if you're in the high net income, things like that, you get that tax write-off, just like you purchased the property yourself.
Yeah, you get all the perks of owning the real estate without the headaches of being a landlord. So you get those tax benefits, you get cash flow, you get depreciation, you get upside equity. So you get all of those things, and they're definitely alternatives, right? This isn't the only strategy, and I think you've got to figure out what works for you and maybe even try out a couple of things to figure out what's best for your situation. You mentioned turnkey. Turnkey rentals are another good option. The difference for turnkey is you are still putting your name on the loan. You're still buying the asset. You're still technically and completely responsible when you buy a turnkey property. And a lot of the times the value has already been taken out, by that turnkey provider. They've already bought it at a lower number. They've already renovated it. They've already done a lot of the work to get the value. So you're now buying this asset more retail as opposed to getting it wholesale where you're going to be able to create more value and equity for yourself. So there's pros and cons. Again, on a turnkey, maybe it's a single family, maybe it's 2-unit. It's either going to be 100% occupied or 100% vacant, usually on a house. So you have things like that you have to navigate. And if you're out of market, maybe you only have, a part-time property manager, maybe a part-time maintenance person. What happens if that person leaves? Now you got to start all over. So just, little things like that. And again, there's not a right or wrong way to invest. I don't want to sound like I'm, saying turnkeys are bad. They're not. It just depends on your strategy and what you want to do.
Right. Yeah. And you're 100% right too. I probably shouldn't even have said turnkey because it's not the phrase where we're talking about.
Yeah.
But you are right. Whenever people do turnkey, a lot of the profits are taken ahead of time. The investor's buying the property, making the markup, fixing it, and you're kind of buying it at retail, but still it's kind of passive because you don't have to do much, but totally different animal here. Hey, John, let's talk about a little bit so the difference between single families. I have to, like you said, I have to worry about what's the house down the street selling for, and that dictates what my house is worth, right?
Yep.
Explain to everybody on commercial and multis how the property value is determined.
Yeah, there's a formula, right? It's NOI, cap rate equals value, okay? So The NOI is the net operating income. So that's all the income minus the expenses. That's going to be your NOI. So if you can drive the NOI, if you can increase that NOI, that is how you create value for a property like this. Now that cap rate, that can fluctuate a little bit, but the cap rate is just a metric that's used to determine how much return investors want for that type of property. So in a market like it is currently, especially if interest rates are a little bit higher, well, investors want a little bit more return because they're going to have to pay a little bit more in interest rates, right? So that return, that cap rate is going up. But generally speaking, cap rates are going to be low in great, highly desirable locations because they're desirable. So people are willing to accept less in return because it's such a great location. They're going to hold those assets longer. Think about Manhattan, right, in New York. People are happy to take a lower return on a piece of Manhattan versus maybe a rougher part of a city. Let's just say I don't know, just some rough city, right? Maybe there's not as much demand and will to own property there, so you're going to need a higher return, more cash flow. You're going to need more money as a return to own that property, or own in that area. So the cap rate is going to be higher there. So if you can look at properties where you have a general sense of where the NOI is, but you can drive that and you can increase it, that's how you're creating value in these commercial real estate deals. Conversely, with single family houses, residential houses, there you're simply looking at comps. You're going to look at it and see, what did the guy down the street get? What kind of finishes do they have in their property? Here's what this property is worth. With commercial real estate, we're looking at the numbers. We're looking at simply the numbers, the NOI, how much cash is this thing producing, and that's going to be your valuation.
Yeah, and that's huge too, because if you have experience and you can see things that other people can't see in a property, you can go in and increase pretty much the income immediately by maybe different occupancy or making places nicer. Rent goes up and your property value just went up immediately. Like you kind of control that stuff. So that's huge.
Yeah, that's
another
it.
reason why you want to deal
it.
with professionals, right?
Absolutely. Well, and you're dealing with professionals who understand that. But then second, you're going to go in with a business plan to force appreciation, right? You can come in and hope it appreciates, right? And just say, hey, it's a great area. Let's hold it 10 years. I think it's going to go up. But that's not what we do. We go in with a specific business plan. We've identified an opportunity to increase the value. And then once we acquire that property, we're going to implement that business plan to drive rents. So it could be a combination of rent increases. How do you drive rents? Well, we're going to renovate the units. Maybe we're going to fix up the bathrooms, modernize them, fix up the kitchens, put in new appliances, change the flooring, change the light fixtures. We can go ahead and do all those things to make the property more appealing and increase rents and attract, higher leases there. The other thing we can do is look at the amenities. So we can play around with the amenities. Maybe we change the amenities. Maybe we add amenities. Maybe we can add some different fees or services to the resident. But we can also look at the expenses and say, hey, maybe we can bring in different vendors and get some of these costs down. Maybe we can challenge, some of these individuals or challenge some of these line items, and we can make some savings or make some reductions. So all those different things come into how you actually drive a more efficient business. And that's really the key thing. You are running a business when you invest in commercial real estate. The NOI, the net operating income, that income statement, that's what's key. And you want to have a strong business plan to increase that operations. Sometimes with the house, you're not really thinking of it as a business. You're thinking of it as, oh, I'm going to come in and make this kitchen really nice and make this bathroom really nice, and it should be worth X when I'm done. And maybe you're right, maybe you're not, right? But in this case, yes, we're using a similar mindset when we're thinking about renovations, but it's not really about making a nice bathroom. It's about understanding, what kind of rent can we get and how do we drive that NOI, and then putting together the right business plan that affords me the ability to do that.
Yeah, and they're really good points there. Now let me ask you this: so you do a syndications. Like, what's your audience look like that is a really good fit for that?
Yeah, syndications are a great way to invest in real estate. I think the first thing is you have to understand that you are going to be passive. So if you're hands-on, you've been listening to everything Brian has said and you want to go out there and rip the day, this may not be the thing for you. I do have an alternative though. If you're that person, there is one way this could work. But generally speaking, if you're hands-on, you need to know everything. You want to be on site. You want to meet the contractor. This may not be the strategy. This is passive. This is for that busy professional, the doctor, the entrepreneur, the engineer, the IT sales professional. that person has a busy, demanding job who wants to use real estate as a tool, not necessarily as the next job or the next career for them. So if you have money, you're making money now, you want to expand that money, you want to invest it in income producing, appreciating assets, this is where syndication comes into play. Now, typically our deals and most operators, they will have minimum investment starting around $50,000 and going up. Sometimes it goes lower to 25,000, but usually 50K is what you see. So you need to be somewhat liquid to be able to invest that amount. But one thing that I have found is even for active investors, a lot of times they will invest in these syndication deals passively to offset some of the income they're making from their active deals. Or if they have like an IRA account or maybe a solo 401k or something like that, they may invest using those retirement funds. So those are two ways that you can still invest if you are an active investor, because you're somewhat limited in what you can do with those retirement accounts anyway. And then from a depreciation standpoint or a tax standpoint, the deals we typically do, they have some phenomenal tax benefits. Some of the laws are starting to change, but usually, or at least on deals we've seen, we've been able to write off almost half of the investment. So if you were to invest $100,000, that first year you're getting a negative K1 of like $50,000 that you're going to lose. So you can take that and you can apply that against other passive income gains that you have. And that's really a great tool for many investors. Now, I'm not a CPA, so you need to talk to your own CPA. Don't, take that for gospel. But you can understand why some active investors turn to syndications to help supplement some of what they're doing in their portfolio.
Yeah, and that's huge too. Even if it just takes you down to one tax bracket, like that's real money there.
Absolutely, absolutely. And the thing too is, if you're a real estate professional, you can take that down the tax bracket. And if you have a spouse who maybe has a W-2 job, well, now you can take this across kind of your collective income, because if it drops you down lower, well, now as you look at the way you file your taxes jointly, it might take you down that tax bracket. So it's just one of those things where you want to talk to a tax professional, understand your situation, and then recognize, okay, what would need to happen for us to, save on our taxes? And maybe it's, hey, you need to show a loss of $20,000. And if that's the case, you want to know that sooner rather than later, right? You don't want to know that, early in the year when it's too late. But if you can find that out and then look for investments where you can show that paper loss, that's going to allow you to save more than just, that money on the taxes, but it's going to allow you the time now to invest in those different assets, not to have to pay these additional taxes. And it could be a great way for you to just put together a great tax strategy.
Yeah, I agree. Hey, different topic. What are you seeing on the marketing side for multis? You doing anything there?
Yeah, multifamily is interesting because on the smaller stuff, I think you can definitely do some great marketing tactics. Everything from direct to market or direct to owner campaigns, mailers. I get text messages I feel like at least once a week for somebody trying to buy my property. So I know people are using SMS. On larger stuff though, it's not quite as effective. And part of it is when you're dealing with someone who owns 100+ units, they're usually not going to get a postcard and call you back and decide to sell it to you off of a postcard. There's a different level of sophistication. And going back to the professionalism, this is the downside. Well, if you've got a business where you got 100 residents, you've got enough income to hire a property management company, you're usually not in a distressed situation where you have to sell and you need to sell. So in that space, when you're going to the higher ones, you're usually now focused more on relationships. You're focused more on broker relationships, maybe introductions and connections to these owners. That's going to be more of the way you approach it. But I think at the 50 units and below, a lot of the good marketing tactics still work. So direct mail, SMS. I'm a big fan of finding ways to engage with people. So for instance, one tip that I love is let's just say you're going to use direct mail. Yes, we can send them postcards saying, hey, I want to buy your property. Another great tip though is to say, hey, this property down the street from you is getting higher rents, or I've put together this report on rents for this area. If you want to check it out, download it here. Or maybe you host a meetup and you're inviting local investors in this submarket, local multifamily owners in a submarket to come and learn, what they should expect for 2023, right? But maybe you're doing something a little different than just asking them to sell their house, because many of them are very sophisticated. They're not going to be distressed. And you really have to build a relationship with these individuals, because some of them are mom and pop owners who've had it for 20 years, 30 years, and they want to sell to a person. They want to sell to somebody who they believe in, and they want to find somebody who maybe reminds them of them maybe 15, 20 years ago, as opposed to just listing it with the broker. Because that's what you're competing with, right? You're competing with, why not just list it with the broker who will sell it for top dollar? Why would I sell it with you? And that human component is probably going to be your best bet to get something off market.
Yeah, and you know what? That's spot on too, because you figure people have 100 units plus, or even 50 units. They're not distressed, and they're not going to call a postcard. They're going to talk to their property manager or whoever and say, hey, do you know anyone looking to buy a place? Or talk to their network. So yeah, relationships, huge. I like those tips too, because thinking outside the box, like meetup or giving them some value, building a relationship. Yeah, that's a really good tip there.
Yeah, absolutely.
Hey, John, what's the best way for anybody to reach out to you?
Man, there's two things. We were fortunate enough to get you on our show, Multifamily Insights, and I implore everyone to check that out. That's available anywhere you listen to podcasts. The other thing, though, is we have a sample deal package on our website. And if you are interested remotely in multifamily, this is great whether you want to be active or you want to be passive. And as a marketer, if you're going to be raising money for your deals, you want to know what you should be telling people, what kind of information needs to be included. And this sample deal package allows you to wrap your head around that. So you can check that out at casmoncapital.com/sample deal. And again, whether you're active and you want to put together your own deals, still for me, take a look at what we put together in this sample deal package and try to take some of those things, and you can include that in your own deals moving forward. And if you want to be passive, this will give you a chance to wrap your head around deal structure, some of the terminology, and just kind of get on our list to learn a little bit more about what that process looks like.
Yeah, cool, man. Yeah, so everyone, check that out. The links will be in the show notes also. Hey, John, thanks for coming on. We appreciate you.
Absolutely, Brian. Thank you for having me today.
Hey, quick question before you go. What's your favorite book?
Oh, man, it depends on the day and what we're talking about, but I got to go with Atomic Habits by James Clear. I just love the immediate actionability of that. I don't know if that's a word. I feel like I just made it up. But the actionability of that book is amazing, so I love that one.
All right, cool. Yeah, appreciate it. All right, man. Hey, thanks for coming on. Everyone, thanks for listening. Get out there, crush it, close some deals. We'll see you next time.